Welcome to the podcast where we cut through hype and talk real tech, real impact, and real challenges. I'm Indu Malik. Banking and FinTech are evolving faster than most regulators, institutions, and even customers can keep up with. And this evolution feels faster than anything we have seen before. Aakash, you've been at the forefront of this. Why does it feel like we're at a breaking point?
Because the pace outstrips comprehension. It seems to outpace the ability of regulators to fully comprehend its implications. It outpaces traditional institutions. And it even outpaces the ability of customers to understand what's happening. Every day, new applications appear, promising to make managing our money easier, faster, more accessible. This constant stream of innovation creates a sense of urgency. Banks feel immense pressure to adapt or risk being left behind by nimbler competitors who are redefining the very nature of finance. It's a race where the finish line keeps moving further away.
So it's this feeling of a race with no end in sight. But what's actually powering this engine? What are the core technologies driving this shift?
It's driven by powerful new technologies, artificial intelligence, open banking APIs, mobile platforms. They are the engines powering a fundamental shift in how financial services are designed, delivered, and consumed.
Let's break that down. You say a fundamental shift. What does that really mean? How has the very idea of a bank changed?
For generations, a bank was a physical building, marble and stone, designed to project stability. Your relationship with money was mediated through tellers and loan officers inside those walls. Banking was a destination you had to visit. The bank was a fortress built on trust and physical presence. However, over the past 2 decades, the foundation of banking has moved from solid ground to the fluid world of digital code. The bank is no longer just a building, it is becoming a platform.
So it's not just about having a website or a mobile app. You're describing a complete architectural shift. Why did this happen?
It was driven by the realization that banks could not innovate fast enough on their own. The digital world moves at a speed that traditional organizations struggle to match. FinTech startups began offering slick, user-friendly solutions for specific needs, like payments, investments, or loans. Instead of competing with every single one, forward-thinking banks saw an opportunity in collaboration. By transforming their core infrastructure into a platform, they could allow these nimble fintechs to access their services, effectively outsourcing innovation.
So the bank becomes a wholesaler of financial capabilities, and the technology that makes this connection possible is the API, the Application Programming Interface.
Exactly. An API is a secure doorway, letting one program request information or trigger an action from another. Before APIs, bank systems were closed fortresses. The API revolution effectively knocked down the walls of these digital fortresses.
And this wasn't just a choice by the banks, was it? Regulation played a major role here, especially in Europe.
That's right. Initiatives like PSD2 in Europe mandated open banking APIs. Regulators understood that forcing banks to open up their data with customer permission would increase competition and spur innovation. It leveled the playing field. This created a new, interconnected ecosystem.
And this leads to the concept of embedded finance, where banking services appear in non-financial apps.
Precisely. Instead of going to a bank for a loan, the loan comes to you exactly when you need it. The service is embedded so seamlessly, it feels like a natural part of the process. When you use Uber, you don't pull out a card. When you see buy now, pay later at checkout, that's embedded lending. For traditional banks, this is both a massive opportunity and an existential threat. The opportunity is to be the invisible provider powering many apps. The threat is brand erosion. If customers deal with Apple or Amazon for finance, their tie to the bank weakens.
So this shift to a platform model has completely rewired customer expectations. It's all about speed and choice now.
People are conditioned by Netflix, Amazon, Google. They expect services to be instant, personalized and available 24/7. They no longer have patience for filling out paper forms or waiting days for a decision. They can now assemble their own financial toolkit. Loyalty is no longer guaranteed.
This brings us to the other major engine of change, artificial intelligence. There's so much hype. In simple terms, what is AI's real role in finance?
In finance, think of AI not as a conscious machine, but as a powerful automation engine. It's a set of programs designed to perform tasks that normally require human intelligence, like recognizing patterns and making predictions. Unlike traditional software that follows rigid rules, AI systems can adapt and improve as they see more information.
So it's about learning from data at a massive scale. Where is this being applied successfully right now? What's the what works part of the equation?
One of the most successful use cases is in fraud detection. AI can analyze every single transaction in real time, learn a customer's normal spending patterns, and instantly flag or block anything that deviates. It's also used in credit scoring, using alternative data to include people the old system missed. And in personalization, offering proactive advice to help customers improve their financial health.
That all sounds incredibly positive, but the chapter is, what works, what's dangerous? So what's the dark side of this?
The primary risk is algorithmic bias. An AI model is only as good as the data it learns from. If historical data reflects past societal biases, like lending less to certain neighborhoods, the AI will learn and perpetuate that bias at a massive scale. It might unfairly deny loans, not because applicants are riskier, but because the algorithm is simply mirroring biased data. Then there's the lack of context. AI doesn't understand context, it understands patterns. It might flag a legitimate transaction as fraud just because you're traveling, causing your card to be declined at a critical moment.
And this is compounded by the black box problem, where even the creators don't fully understand how the AI is making its decisions.
Exactly. If a bank denies a loan using a black box model, they can't give a clear reason why. That lack of transparency makes it impossible to challenge decisions or ensure fairness. And because AI operates at scale, one flawed algorithm can cause systemic damage almost instantly.
So how do we manage this? How do we use this powerful tool without abdicating our own judgment and responsibility?
Robust human oversight is non-negotiable. We need a human-in-the-loop approach, where an expert reviews and validates high-stakes decisions. It combines the machine's power with a person's contextual understanding and ethical judgment. Ultimately, we must foster a culture of healthy skepticism. We need to constantly ask not just what the AI can do, but what it might do wrong.
This tension between promise and peril seems most acute when we talk about financial inclusion. FinTech promises to bank the unbanked, but is it that simple?
The successes have been genuinely life-changing. The proliferation of mobile phones allowed companies like M-Pesa in Kenya to let millions open a digital wallet, store money securely, and make payments with a simple text message. This has provided a level of financial security and convenience that was previously unimaginable, enabling people to build businesses and create a path towards economic stability.
That's the powerful positive narrative, but you've also warned about the dark side of this, the rise of digital debt traps.
Because for every story of empowerment, there's a cautionary tale. The same technologies that make it easy to get a loan also make it incredibly easy to fall into a cycle of debt. Inclusion without literacy is dangerous. Many lending apps are designed to be frictionless, offering instant credit. But the promise of quick cash can obscure high interest rates and hidden fees. This is not financial inclusion. It is a new, more efficient form of predatory lending. When borrowers default, some unscrupulous companies resort to aggressive collection tactics, like debt shaming. They message the borrower's friends and family, destroying their reputation and creating immense psychological distress.
So what are the safeguards? How do we ensure that inclusion leads to empowerment, not exploitation?
First, transparency. Regulators must mandate crystal clear information. No hidden fees, no complex jargon. Second, regulatory intervention to cap interest rates and outlaw aggressive collection. And third, we must invest heavily in financial and digital literacy programs. True financial inclusion is not measured by how many loans are given, but by whether people's lives are sustainably improved.
This leads us to another major risk area that's exploding: fraud. You've said that innovation itself is fueling this rise. How?
Whenever a new service is launched and scales rapidly, criminals are the first to probe its defenses. The pressure on FinTech to grow fast means security often gets pushed down the list. That lack of friction is what fraudsters love. Identity theft has exploded. Massive data breaches leak personal information onto the dark web, which fraudsters buy to open new accounts or take over existing ones.
And it's not just simple identity theft. You've written about more patient, complex schemes like synthetic identity fraud.
Yes. Fraudsters combine real stolen info, like a social security number, with fake details to create a new, non-existent person. They build its credit history over months, then apply for huge loans and vanish, leaving massive losses. But the weakest link isn't always the technology. It's often us. Social engineering scams trick people into giving up their own details. Technology isn't the weakest link. Humans are.
And the scary part is that the same AI that banks use to fight fraud is also being used by the criminals to make their attacks more effective.
It's a technological arms race. AI can generate hyper-realistic phishing emails. And the rise of deepfake technology, AI-generated voice and video, is even more alarming. Imagine getting a call from someone who sounds exactly like your boss, asking for an urgent transfer.
With all these escalating risks, the role of regulation becomes critical. But in tech circles, it's often seen as a blocker to innovation. Is that a fair assessment?
Calling regulation a blocker is a lazy take. It's a dangerously incomplete perspective. In a landscape where risks are becoming this interconnected, smart regulation is not a problem. It is a vital part of the solution. It provides the essential framework that builds trust, ensures a level playing field, and creates a safety net for when things inevitably go wrong. It establishes minimum standards for security and data privacy. It defines liability. Who is responsible when a customer loses money to fraud? And it provides consumer remedies. It moves security from a competitive feature to a baseline requirement.
So, let's bring this all together. We've discussed platforms, AI, inclusion, fraud, regulation. Paint a realistic picture for us. What will banking actually feel like in 2030?
It's a landscape defined by fundamental trade-offs. The world of finance will be faster and more convenient. You won't go to a bank in 2030. Physical branches will be a rarity. It will be replaced by sophisticated apps and invisible, embedded services. But this progress is paid for with increased complexity and new, concentrated forms of risk. The winners will be the digitally savvy consumers who can leverage the choice while avoiding the traps. The winning institutions will be those that successfully transform into platforms, either with a strong brand or as the indispensable invisible plumbing.
So as we close, what is the final reality check? What is the one question that leaders in this space should be asking themselves?
The journey has been driven by an obsession with speed and scale. The core question in boardrooms has been, how fast can we grow? That mindset has powered innovation, but it's also led us to overlook the cracks forming in the foundation. The time has come to change the question. Stop asking how fast you can scale. Ask what breaks when you do. This shift forces a more sober approach. It encourages us to prioritize resilience over speed, to build with foresight, and to place the long-term well-being of the system above the short-term allure of frictionless speed.